I think that kind of brings me to another question I wanted to bring up. Just what is the Fed put? Maybe if you could explain that to people, and is it over? I mean, it seems like maybe we are kind of seeing the end of that liquidity backstop that the Federal Reserve's been providing. But maybe if you can kind of talk a little bit to what the Fed put is.
Yeah, so one of the Fed mandates is buyer of last resort. And so they are going to use all of their tools and everything, that's available to them to save a falling economy. Um, so everyone in the past has felt really safe and secure. So picking the bottom was often was often seemed not as risky. In addition, one strategy in options trading with puts is you buy the put in order to protect the downside, in order to really buy more stocks. And then your stocks outperform what you lose on buying that insurance policy. And over time, let's look back in history for the last 30 years, a little bit more than that, actually, 35 to 40 years, the Fed has slowly been lowering the interest rate. Now, is that game over? And so as they lower that interest rate, what they do is they balloon out the asset values and thus save the market from going down. Now, I think that put still exists, but the question is, where is it? And I think it's not as close to at the money as it used to be in the past. So this Fed put is way further out of the money, and you may have to endure a lot more downside than you have in the past based upon the positive returns we've seen recently in order to find that where that put is. So, if we were talking about $100 economy and the put was at $80, that put might be more at $55 today.
Sure, and I mean that kind of goes a bit to the Fed's dual mandate, right? There's the mandate around supporting growth, but there's also that other mandate around price stability. And with what we've seen in inflation, all of a sudden that mandate around price stability and the Fed seeming to get more serious about trying to rein that inflation back to 2%. All of a sudden that kind of changes where they're willing to step in and provide liquidity to facilitate growth. I mean, wouldn't you say that's a bit of what's going on here?
Yeah, I mean, let's be clear. Inflation, headline inflation, we as citizens think about as the food and the gas and in our housing, but asset price inflation is just another form of inflation. And so, a lot of people like to think that they've been really, really smart for the last 2 years, and their investments have been really, really good investments. But there's no doubt about a lot of those returns are just inflationary returns that they're seeing in their assets. So yes, the dual and let's also be clear that Jerome Powell has been very, very explicit that Fed put is not where it used to be. And he has actually used the word pain, which I don't know that anyone has ever heard come from a Fed chair before. So, let's temper expectations on the upside because the Fed speak and some of their actions have really been extraordinary, and so the mandate to control for price stability and to control inflation right now is trumping any other mandate, and he's been very, very clear about that.
Yeah, wouldn't you say that's some of what's been kind of driving the decline in markets is the market having to reprice that Fed put where it comes in, where effectively they can expect that the Fed to provide liquidity to help risk assets is really not being where it used to be and allowing for more downside in this market.
Yeah, and you can also look at that as the Fed put. The market is just going to be a little bit more volatile, and that Fed put will be a little bit more expensive.
And then it does seem futures markets right now have been kind of pushing out when they expect the Fed to start supplying a little bit liquidity or start moving to more of a easing bias. I think it seems to be kind of, at one point it was maybe the start of next year, and now it seems to be really kind of moving more towards almost maybe even Q4 of next year before those markets seem to be expecting the Fed to be moving more to an easing bias.
Yeah, and so let's be honest, the industry is a sales industry, and they are in the business of selling stocks and selling optimism. And so I think that some of the near term rhetoric and even market movement that you see is optimistic. The other thing that you're seeing is that the Fed has a tough mandate. I mean, this is like trying to, stop the world's largest ship before it hits land. So it's a difficult proposition for them. And I would say that this inflation is sticky the way it's measured. So I think that the headline is going to stay a little bit higher than everyone thinks for a little bit longer. And if the Fed is data dependent and they look at an elevated CPI number or inflation headline number relative to a not so bad employment number, then they are likely to continue on this path. And whether they go too far is anyone's guess. But I still go back to just caution. Let's be patient. Let's watch. Let's see how this plays out, and not be. Let's not be involved in the guessing game that a lot of these people are involved in.
Sure, and it does seem like an incredibly difficult investing environment we're in right now. I mean, we do have inflation, so cash is getting eroded. We've certainly seen risk, especially around speculative assets for equities. I mean, although commodities had a nice run up, they've been selling off lately. They're broad-based, aren't much better than flat for the year. Gold's actually off. We've seen a strong dollar. Real estate, residential and commercial, certainly has its issues. So, I mean, to kind of like sum up that, the Fed and risk assets, there's no easy answers here. I mean, it's created a very kind of complicated picture for managers to have to navigate, wouldn't you say?
For sure. And there's a tendency in our industry to rely on what you know. And I don't think that anyone has ever been through a 2-year pandemic where they shut down the economy and just handed everyone money. So the environment that Powell is dealing with, the environment that we are in is unprecedented, and we've never seen it before. So I would caution that I do believe that there is more speculative risk and asset inflation than potentially anyone has seen in the past. And certainly the economic environment is more volatile than anything we've seen in the past. And we need to be patient and just see what happens. Historically, we've had you tend to, if you invest your money in a low risk asset like lending it to the government, you would like to at least get paid back for the money that the value that you're losing on your dollar. So said in data terms, the nominal GDP, rate of growth of GDP, which equals growth plus inflation, tends to historically be right around the rate of return that you would expect from a treasury bond. That is not close right now, given that the inflation numbers are somewhere, around 8%, dropping maybe to 5%. And when we say dropping to 5%, let's still remember the Fed mandate is 2%. So, you would like to get paid back for the loss in value of your dollar. And we all know that the Fed has said that they are going to slay this inflation dragon. How long does it take? How patient can you be? Are you going to get the money back that you're losing today? And that's that's the thing. You can't just print $2 trillion and hand it out and not expect that it sort of devalues the dollar that everyone had in their hand, 2 years ago.